So this is Matt Cohen speaking. So thanks so much for inviting us to do this. So today, we're going to give our Venture Capital 101 presentation. This is presentation one in a series of various topics we can present, and we have presented at various universities around the country. But this one's the basics. So, we'll just introduce ourselves, and then I'll go over quickly the overview for the talk. So I'm a partner on the life science investment team at OUP. I'm a PhD cell biologist by training from Penn, and spent a number of years out of the New York City office for LEK Consulting, which is a large strategy management consulting firm where I primarily focused on working with biopharma, medical device, and diagnostics company clients. I've been with the firm now for at OUP for 6 years. And then John can introduce himself.
This is John Lee. I'm a principal on the tech team here. I largely focus on software investing, sometimes hardware investing here on the physical science side. I've been with Osage for about 7 years. Prior to that, I was an associate at Lux Capital. Before that, I was with the Mahindra Group over in Asia, focusing on in-house startups and acquisitions.
Okay, great. So moving on to the next slide. So the overview here for today's talk, we're going to start with an overview of venture capital funds in general and how they work, how they operate, what our incentives are, how we get paid, all the things to help you understand, again, where's the VC fund you may be pitching or talking to coming from, and maybe try to understand maybe some questions you could ask them to understand how you might fit in with what they are doing. Next, we'll talk about, John will actually talk about capital formation, so various sources for funding, not just venture capital, but other sources that you might explore along the way. And the next part will be just talking about pitching. So, what a good pitch deck looks like, what are the best ways to approach VCs and get feedback and get in contact with various folks. And then the last part will just be about how VCs evaluate the investments we make. So how do we make decisions? What are the kinds of things we look like? What does due diligence look like? What goes into an investment memo that a VC might use to convince their partners or their firm to make the investment? And if you understand what it is that they have to put together from their end to make a compelling case for why they want to make the investment, it helps you understand and appreciate why they're asking the questions they're asking you, because on the back end, they're trying to put together a document with those answers that's compelling. So we'll jump right into it. So basically, for a VC fund, it's organized with two major parties. One are the general partners. These are actually the VC individuals themselves. Those are the ones that go and then raise money from, at the bottom there, the limited partners. So limited partners are the investors. So one misnomer, some people think that the VCs, all the money that they invest is their own personal money. That's not the case. So VCs go out and raise money just like you would as a startup, and they do it from groups like insurance companies, endowments, pension funds, family offices, and high net worth individuals who want to invest their money in private companies, but maybe don't have the expertise to invest in a certain area. So it's the VCs themselves that they give the money to actually make those investment decisions and manage that money. The GPs are assisted with it by a team consisting of principals, associates, analysts. Those are the folks who do a lot of the work. Read a lot of the literature, ask a lot of the questions. They actually go and find a lot of deals. So, if you think, oh, I'm talking to an associate, I'm not talking to the partner, that's okay. Vast majority of the time, deals come into funds through the junior team, and that's a very valid way to get in the door. GPs, they basically typically focus on a specific area. So some funds just do life sciences, some just do tech. Our fund does both, but they usually have some sort of expertise. Fundraising itself, for a VC, could take months to a year just to be able to raise a fund. So not much different than for you if you're starting a company. It could take a long time to raise capital. The limited partners themselves, they aren't giving the VCs all the money at once. They give the money as the money is needed or called to make investments. And usually within a limited partners portfolio, like a large endowment from UCSD's endowment, only a small portion of that's actually allocated to what's called the alternative investment class, which includes venture capital, but lots of other things too, like real estate. And those things are illiquid, they're very risky, but presumably could return more on that money, but the money is tied up. And that's a pretty small fraction of the total investment dollars, in the US broadly. So to talk a little bit about how VCs actually get compensated, there's two mechanisms for that. The first are the management fees. And so if a VC has a fund that's $100 million and their management fee is 2%, they'll $2 million per year goes to the VCs. That's not just salary in their pocket, but that pays for everything. Overhead, space, due diligence expenses, travel, really everything it takes to run the fund. So that just kind of pays the bills. On the bottom, though, is the carried interest. This is the risk-sharing part of how VCs get paid. So basically the way it works is, again, I'll use the example of having a $100 million fund. If I'm a VC and I have a $100 million fund, I invest all of that money in companies, then I start exiting my investments and money starts coming back to me because some of those investments are successful and they return some capital. The first $100 million I get back is principal. I have to pay that back to the LPs, to my investors. I don't get any of that. So all the principal goes back first. And then anything above principal, in this case, is profit. And that gets split 80-20. So 80% of the profit goes over the first 100 million return goes to the LPs, those investors, and then the other 20% goes to the general partners or the VCs. So a couple of important factors on the life cycle of a VC fund. So these funds are not what's known as evergreen, meaning the money is always there and they're constantly getting more of it. VCs raise money and raise an individual fund. So you may see a VCs on Fund 5 or Fund 6. That means they've raised 5 or 6 separate, discrete funds. Each of those funds has a 10-year lifespan, and you can often extend those for 1 or 2 years. But typically the max is a 12-year lifespan for those. Those investments that people are making are typically in the first 4 or 5 years. That's the investment period of the fund. And then the next 4 or 5 years are basically the period of the fund where these investments mature and they try to exit those investments. So, one question you might ask a VC is, what year are you of your current fund? Or, if they're in year, let's say 4 or 5 of the fund, and you think it's going to take 8 years or 9 years for you to achieve an exit, may not be a great fit just from a timing perspective for where their fund currently is in its life cycle. But if they're in year 1, it may be just fine. So, depending on how long you think it might take you to, achieve a success, you want to be, a little bit cautious and understand, where your investors are in their fund, because you don't want to be necessarily maybe pressured to exit the business early before you've achieved the milestone you set out to achieve. In terms of investments and reserving money, this is very, very common and typical in VC. So for every dollar a VC invests, they may reserve $2 or $3. So if I invest $5 million today, and I may reserve in my fund another $10 million for your company. And that's because presumably the money you raise today is not the money, the only money you'll need for the rest of your business's life. You may need to raise more money. And so VCs want to make sure that they have capital in their fund reserved for those investments. So while maybe you're only getting 5, you probably take up 15 million, maybe of the total 100 million they have in their fund, even though they've only given you 5 to start. And then, once 80% of a fund is invested or reserved, VCs will typically start to raise a new fund. So the idea is you're never out of the market. You always have a new fund to immediately invest. That doesn't always work out that way. So you may find sometimes where you're talking to a VC who says, our new fund's not closed yet. We can't invest for 6 more months or 9 more months. And it could be because you don't fit into their prior fund that they're still investing because your company's too early stage for that fund. Or it could be they're out of money in that fund and they haven't raised the new one yet. And these things can happen. So that's basically it for the overview and how VC funds work. But next I'm going to turn it over to John, and we'll dive more deeply into the various funding sources beyond just VC and understanding better the dynamics that VC funds consider when making decisions.
And so, one of the considerations when you're going out to raise capital is what type of capital you'd like to raise. A lot of people orient towards venture capital largely because people understand that generally is what startups should do, but this is not necessarily the case. VC or venture capital is actually some of the most expensive capital that you can raise, and you're generally giving up not only a lot of control of your company, but also taking a lot of dilution to bring in that capital. And so if you were to rank it compared to debt and other forms of capital, it is probably one of the most expensive forms of capital. And so we thought it'd be helpful to place it in context to some of the other sources of capital available for startups. So if we want to move to the next slide. So this is just a list of the different sources of capital that generally startups are raising from. And then on the right side, it highlights some of the function and stages of companies that raise capital at these stages. And so at the very bottom, oftentimes we find that companies coming out of universities will raise grants via SBIR, STTR, NSF, DARPA. And these grants are fine, particularly if you're running a services shop. There's no need to raise dilutive capital. This is great because this is non-dilutive capital. It can finance a business over time, and in a lot of ways it's considered revenue. And so unless you're building a product or building something that requires a large amount of capital, it doesn't really make sense to go out and raise outside capital if you're able to raise grants from some of these government agencies. Typically, the first stage in raising outside capital is to raise it from friends and family or from individual angels that you may know. This is generally not too expensive of a form of capital, largely because it's coming from your friends and family. There's not usually a lot of preferences or preferred stock available in these types of transactions. And so it usually is a sale of common stock, which doesn't have unique control provisions that venture capital would require. And so I would say that this is typically the first step in going towards a product-oriented company, but there are many examples of companies that are able to build a very large business just off friends and family capital or angel investment. One company would be Microsoft, which took a little bit of capital from friends and family early on, but never really raised again from outside capital. There are other companies as well. Salesforce has really taken very little capital throughout the lifetime of the company. And there are examples of very big companies today that started with just a small capital infusion and immediately got to cash flow positive and never really required the highly dilutive, highly controlling capital that venture capital provides. And so moving above that, crowdfunding has been pretty popular over the last few years. This is also a non-dilutive source of funding. The challenges with crowdfunding is that you're typically promising a product, and a lot of companies fail at the actual execution and delivery of the product. Often it turns out that the companies need more capital to be able to deliver those products and therefore have to go out and raise capital anyway. And so there's been a bit of mixed success around Kickstarters in the go-go, particularly around expectation setting and ability to deliver on product. There've only been a handful of companies that have truly been able to deliver on great products and be able to grow beyond what the initial Kickstarter was. An example of a company that has grown pretty large after Kickstarter would be Boosted Board, which is the electric skateboard. Venture capital is the asset class that Matt and I are involved in. This is a very large asset class in a lot of ways that I'll review in the next slides on kind of how you differentiate between venture firms. Beyond venture, a lot of companies will raise growth financing from either strategics or dedicated growth equity firms that provide lots of different value to companies that are at later stage, but still before public market, and can be very useful sources of capital for scaling the company. So moving to the next slide, we've identified the different probability of moving towards a process with a venture capital firm. And so if you were to start with a large pipeline, most VC firms will see 1,000+ deals a year. And so if 1,000 is a number that you start off with at the top of the funnel, it greatly shrinks at every stage. And so most processes will start with a consideration or initial pitch deck review. About a third of those will move to meeting with management and taking a deeper look at the company. A third of those will then move to a review by the partners. About half of those will then go into due diligence, and a third of the companies that have gone into due diligence will receive a term sheet. Typically at term sheet, there's usually some competition. I would say about 50% of the companies that we issue term sheets to will accept our term sheet. That's really where competition amongst other VC firms comes in. And so the amount of deals closed is actually quite small versus the number of deals considered. We at Osage, we track about 7,000 deals at any given time and are making around 15 investments per year. So the next slide. So this slide highlights different investors or venture investors for different stages of life science companies. And so at the top, you see a typical therapeutics company or the stages of a typical therapeutics company. It starts with company formation, then moving on to early preclinical work, to IND enabling data, to early clinical work, to late clinical, then NDA, PMA, commercial. The funds at the top that are largely considered early stage funds in life sciences are Third Rock, Atlas, Mercury, oftentimes starting companies from scratch, getting involved early on, helping with company formation, and then taking them to kind of preclinical IND. OUP, our fund is really broad. We get involved in almost everything besides true company formation. Occasionally we'll do that, but I would say that in most cases we're getting involved around preclinical to commercial stage companies. Then you have companies that were traditionally, venture firms that were traditionally late stage that have moved much earlier, like the OrbiMeds of the world, to the Frasers. And then you have later stage dedicated funds like Vivo or HIG or Software. And then beyond that, a group of investors that we've seen particularly active over the last decade or so are the crossover investors that are hybrid private capital, private equity, and hedge funds. These include firms like Deerfield, RA Capital, Fidelity. These are funds that historically have invested in later stage companies, in largely so that they can invest also in the public market once the company goes public. As the asset class or the venture assets for life science have moved earlier and earlier, these firms have also moved earlier and earlier. Great, and then moving to the next slide, we focus and do the same analysis on the tech side. In the tech side, the company stages are a little bit different. We start with company formation. Typically, there's a period where a product prototype is created. There's a little bit of traction associated with that. Product market fit is a bit of a vague term, but this is generally kind of around Series B, Series C, where a company has been able to repeatedly sell their product to customer. And beyond that, you raise capital for scale and growth. This is generally where you're hiring large sales teams or you're generating kind of $50 to $100 million in revenue. And so for the very early stage companies within tech, and I would note that this moves all the time in tech, you have companies that are really oriented as incubators, like Y Combinator, Techstar, Bolt, a lot of these companies, or a lot of these firms are taking in companies that have yet formed a product prototype, are taking in an idea and funding them to essentially build the prototype and get initial traction. Beyond that, you have institutionalized investors that invest at what is considered the seed stage. This is when there is perhaps a prototype, but it's still not that well defined. There's not really very much traction in the company. Oftentimes it's pre-traction. This is where investors like First Round Capital or Laro Hippo Ventures or Clive Perkins get involved. OUP gets involved really at all stages. I would say that we're not typically forming companies often, but we often get involved right after company formation, and we can invest all across stages, even later stage companies that are scaling and growing. Most of the mainstream firms that people would consider tier one firms, like the Benchmarks, Sequoias, Andreessens of the world, they're kind of Series A and beyond firms. They're generally investing when companies have just started to show traction on a product that they had just built, and investing at that first round that they see traction, and continually putting in resources beyond that. And as these funds have gotten bigger, they've gotten later and later as well. Not necessarily that they're stopping Series A investing, more that they're doing Series A investing in addition to Series C, Series B, Series E investing. The next category of investors are strategic investors, which also I would say have started to get involved earlier and earlier. Historically, usually these investors are getting involved around product market fit as the companies are scaling growth. We've seen strategic investors go much earlier. Beyond that, there's a large class of firms that have been founded over the last 10 years that are focusing on purely scale and growth stage companies. These are the DSJ Growths of the world, the IVPs, the Inside Venture Partners. They're generally investing in companies that have around $10 million of recurring revenue and trying to grow them into $100 million plus recurring revenue businesses, at which point they'll either sell it to a large strategic or IPO the company. So in the next slides, Matt will go over how generally entrepreneurs should be pitching venture capitalists, just given the unique style of companies that the VCs are generally looking to fund.
Great, yeah, thanks, John. So John gave you some numbers earlier with a bit of a funnel, how 1,000 deals a year that get looked at gets widowed down to making an investment. Here's some more numbers for you. But the reality is the majority of startups and even most academic firms do not require and won't get venture capital. There's plenty of very, very good businesses out there that just don't require VC dollars. Venture capitalists are focused on the really, really big, high upside opportunities. The company could be worth $1 billion or more one day. That's not every company, and that doesn't have to be every company. So if you don't think your idea is necessarily $1 billion idea, but still a good idea, John talked about many other funding opportunities and sources for those ideas. But if you do think you have a big idea, and you do think it's potentially a $1 billion idea, just know that the odds are difficult. They're challenging. The acceptance rate for OUP, for making investments less than 1%. That's pretty typical. So the dollars are out there. There's probably more dollars than there have ever been out there, particularly in life sciences for early stage funding. But it's still a challenge. It still requires a lot of work. So you have to get the pitch deck right. So how do you even get in the door to be able to show somebody your pitch deck, right? So, the first thing to say is the cliche is true. You really only do get one chance to make a first impression. If you go into a pitch to a VC fund and you sit down with somebody and it totally bombs and doesn't go well, you may not get another shot. Now, I would say not every VC fund is this way. OUP, we like to talk to companies early, even maybe before you're ready to pitch. Maybe the pitch deck's not really that well formed or thought out yet. And we're happy to get feedback and then talk to you again in 6 months or 12 months or 24 months, whatever it is, and listen to the story again and see how it's evolved. That's how we do things. but not every VC is like that. A lot of groups say, they have so many things to work on. They say, I've seen that before, wasn't interested. Let's move on. So the best way to actually get introduced to VCs, is to go through a trusted friend or advisor. Those warm introductions tend to work best, particularly if it's somebody that the VC trusts or knows, or maybe is even invested in before. But what I want to say is, cold emailing is not the worst thing you could possibly do. I was participated in a Biocom event in San Diego last week, and this is something I said to the entrepreneurs in the audience during that event, which is, it's your job to get your company funded. It's your baby, and you got to do everything you possibly can to make that happen. So if that means cold emailing a VC because you think they're a great fit, you shouldn't not do that. But the reality is, not everyone will get back to you. Everyone's very busy, and you just have to be persistent and sometimes find other avenues that may work better, like warm introductions through mutual acquaintances. For those initial interactions, whether it's a phone call or you're just sending a pitch deck or sending an executive summary, just make sure it's concise and compelling and stands alone. So one thing that I think some academic entrepreneurs fall into the trap of is sending a pitch deck with information on slides that needs to be talked through. You have to be there to present the slides. You have to use your words, or nobody's going to understand what's on them. That just doesn't really work well for this sort of format. Oftentimes, you're going to be asked for a pitch deck. You're going to have to send it, and then they're going to decide, do they want to set up an hour phone call to talk more about it? So the pitch deck has to be interpretable just as a standalone document. So it really should talk about, who you are, your background, accomplishments, why you're well situated for either running this business or starting this business or having the expertise to develop the science that you've developed. You want to include some data that justifies, why you're so excited about it, why you have commitment, and why they should be compelled by that data. To stop here on the data point for just a second, I think it's important to note and point out that I like to say that data is not confidential. So, if you think, I can't share data because my data is not published, so it's confidential, you have to find a way to get past that and get over that. If you share data, no VC is looking to scoop you and publish ahead of you. That's not what our job is. That's not what we're interested in doing. But what your job is to get them, or a VC compelled enough to spend more time on it. And the only way to do that is to provide some data. So what you can do, though, is hide how you generated that data. So if you show some really compelling data and you say, hey, look what happened in this mouse model of disease, or look what we can do with regards to cybersecurity attacks. You don't have to say how you did it or how you accomplished it. Maybe you just say we use protein X or molecule Y. You don't need to provide the structure or the how, but showing the what, the actual data is how you catch people's attention. Then you ideally want some information on what the market is you're going after and the size of that market. If you're developing a drug for cancer, you don't need to say, cancer is a big market. I think everyone understands that. So don't get carried away with this. But if it's something obscure or not as well understood, or particularly, for John Lee, in John Lee's case for tech, you want to make sure that you demonstrate you have a good grasp and understanding of what the size of the market is and what the needs are in that market. The next piece is, what you think you're worth in success. One way to do that is comparable. So what other companies have looked like when they've been successful and what they were worth. Again, if you're a therapeutics company developing a drug for cancer, I don't think it's as critical to do something like this. So use your best judgment with what you think you need to tell and explain to people. But understand that the folks you're pitching probably have a really good idea or seen similar companies or similar pitch decks before. So kind of focus on the specifics of your business rather than the generalities of a large market that you may not be addressing all of. You want to mention, what funding you've received to date, other accomplishments, and then again, how much money you're raising, what are you going to do with it, and where does it get you? Not only on the calendar, how much time does it buy you, but what milestones will you achieve with that money? Again, this is the triage stage. So you're trying to get people's attention. You're trying to get them to take a phone call so that you can deliver a pitch. So you really want to be as compelling as you possibly can, but not have the deck be so long that people, get fatigued looking at it and just move on. So here's a basic outline of what that could look like. And again, we can provide the slides, so you don't need to write everything down. But, slide 1, again, elevator pitch, the leadership, the key data. And to get a general sense, you may have one slide for each of these. Maybe the data is 2 slides or 3 slides, because that's an important part. But for most of these, it's probably just 1 slide. So you can imagine the pitch deck being maybe 10 to 20 slides at most. And that's probably satisfactory for a non-confidential pitch deck. And so if you can convince people to take a call on this one, and then they get really interested, and then, they want to get under confidentiality with you, perhaps, you have a longer pitch deck built, that's 30 or 40 slides, more appropriate for a 1-hour conversation where you really get into some of the details and then the confidential information around how you did what you did. So, just maybe some practical suggestions here. First, don't hide anything substantive. It shows, it demonstrates a lot of transparency and honesty on your part if you bring up the gaps or the issues ahead of time and say, look, I know this is one area of the deficiency right now that we either don't understand it or we don't know it, or if you get asked questions, it's fine to say, we just don't know that answer right now, but that's a good question. We haven't thought of that, or hey, we're looking into that. We have some more work to do on that. Here are the experiments we're designing to address that question. But don't hide anything, because the worst thing that can happen is you hide a key issue or problem, and then it's discovered later on in diligence, 3 months later or 6 months later, and at that point it really destroys credibility, and at that point probably the relationship's broken beyond repair. Follow good presentation guidelines. That's this clear, concise, compelling comment. You want to pause as much as you can to allow questions. I recognize I'm not pausing very much, and John and I aren't pausing very much today because we have a lot to get through in an hour. You may feel the same, but do the best you can to stop, see if somebody just speaks up, maybe interjects, jumps in and asks a specific question, because VCs, when they're interested, they'll want to ask questions and sort of get things, the burning question that's in their mind off their mind, so they can, get back to focusing on what you're saying. And like I said, when you don't know an answer, say so. I think it's fine to say I don't know, like anything else in life. So, that big box at the bottom is basically just saying, you're the expert. Everyone recognizes that. But maybe it's the first time an investor is seeing this, and it's just human nature the first time you see something to not understand it. And then the second time you see something, you understand it a little bit better. And then the third time you understand it, even more, and you start to actually get comfortable with what's being said. So know that going in, the first time, they're probably not going to understand everything you say. So you want to make sure you have something really clear and concise and compelling, so that they take away 1 or 2 key things from the conversation that keeps them interested enough to hear it again and get more comfortable. And so finally in this section, just some lessons learned about raising capital. When you target investors, you want to focus on those who've made investments in that same sector or with that same strategy. You want to try to build a diversified investor base. Sometimes it's okay if your company only has 1 VC investor. It's better if they have 2 or more. There's various reasons for that we can talk about later. And so it's a process, right? So unless you've done this 10 times and started 5 different companies before, fundraising can be hard. It's grueling. It's a long process, and you're going to get a lot more no's than yeses. Maybe even worse than NIH funding cutoff limits. It's probably even harder, right, to get funding this way than it is from NIH these days. So you're going to get a lot of no's. You're probably going to have to take lots of meetings. It's going to be slow. You're going to wonder why, it feels like at times it's not progressing at all. You thought they were interested and they're not getting back to you. People get busy. They have lots of things they're working on, lots of pressing issues and needs, maybe within their own existing portfolio. So again, you have to be patient, but persistent. Sometimes we get asked, should I use a private placement agent, like an investment bank that will help me find investors, set up meetings, find people who actually care about the business that I'm developing. There's some positives to doing that. It can make it more efficient from you. It could be, less time consuming. They can find people you may not have find. So, for example, if you want to raise money from angel investors and there are a bunch of, very wealthy families in New York City and you live in San Diego, you may not know all of them and have all those connections, but the investment bankers in Manhattan probably do know some of those groups. Maybe even with family members who have the disease you're trying to treat or that would have a vested interest in what you're doing. So that may be one way to get introductions to groups that you would otherwise not meet. But again, there's downsides. There's cost. You have to pay the investment bank or the placement agent a percentage of the amount of money you raise. And of course, it doesn't completely eliminate your time. You still absolutely have to be involved. You have to do all the pitches and all the meetings, and you still have to answer all the diligence questions and do the whole process. So maybe, I don't know, I can't see you all. If there's any questions, jump in, but I'm going to turn it back over to John.
Great. So the next section we're going to cover is largely how we as investors evaluate investing in companies. And so we'll hit things from team to what type of data that we're looking for, what type of markets, and just generally comprehensively how and our framework for evaluating companies. And so if we move to the next slide, this is just a Merriam-Webster definition of due diligence. And the second definition is a little more applicable for what we do, which is research and analysis of a company or organization done in preparation for a business transaction. Sometimes it's the first, the care that a reasonable person exercises to avoid harm to other persons or their property. But I would say that in general, we're always evaluating companies and we're always doing pretty thorough due diligence on whatever investment we make. There is an element of the unknown in venture, just given that things are so early and so risky. And so it's really important for us to be able to at least find out as much information as possible with the acknowledgement that there is substantial unknown in the types of investments that we do. And so the next slide, this just highlights that entrepreneurs and investors take very different approaches. Entrepreneurs are generally trying to get to a yes. Investors are generally trying to convince themselves that they don't want to do an investment. The middle ground is really where deals generally happen. On this slide, it's a rating of the most important factors for investment selection. This is a survey from lots of different investors. There's an aggregation of all the investors, there's a segmentation of early stage investors, and then a breakdown of IT versus healthcare investors. And so, as you can see, overwhelmingly, if you were to average everything, the team is the most important variable for most investors, by far, almost 4 times greater than the next category, which is product, business model, market, fit, industry. A lot of the reasons for this is that oftentimes when you're starting out a company, there's a lot of unknown, particularly around product and what type of customer you're going after, and oftentimes what type of market you're going after as well. You're usually starting out with a very basic idea and you're gathering data to form it and shape it and pivot it. And most businesses that have been very successful have pivoted a number of times before really landing on a product or business model that makes a lot of sense. And so when we're making early stage investments, what we generally try to do is we back a team that we think can handle the ability to transition and work in an environment of lots of fluctuation and variation. This is a little bit different on the healthcare side or the life science side. As you can see here, the product is much more important or relative to other types of investors, and in some ways more important than the team on the life science side. This is largely because with healthcare and life science investments, you're taking an asset or core IP to the market. Therefore, you've identified generally what the product is, and from that point on, it's really more about execution. And for an execution-driven team, it's a little bit less important than having a team that is visionary, that is really good at understanding and synthesizing markets. It's much more about setting up clinical trials, executing them, making sure you have the right data, and really firing on all cylinders rather than someone that is oriented towards pivoting and trying to figure out a gap in the market. And that's really what I think is the difference between healthcare and IT investors and what they look for. The next few slides, we're going to be going over more in depthly about a breakdown of this, but just a comment that a good idea is not always a good investment. Oftentimes we see great ideas from different entrepreneurs, but there's a lot of flaws in how some of these ideas are executed that don't make them such great investments in the long term. So moving to the next slide, this is just another way of breaking down how the difference between tech and life science look at deals. I would say for tech, usually it's team at the very top, and then for tech, just given the amount of capital that's out there and the type of exits that we need, one of the most important things for us is the size of the market opportunity. And it doesn't necessarily have to be the initial market that is massive. There could be several segmentations of the size market. But this is generally the second largest consideration for diligence when we're thinking about a deal. Obviously, with a caveat that this could change if the product changes substantially. On the life science side, it's a team, then the science and clinical data that has been shown up to that point, which largely speaks to the quality of the product that they want to take to market. So moving to the next slide. As I mentioned before, it's really more about betting on the jockey for us, both on the tech and life science side, perhaps a little bit more important on the tech side. And again, the reason for that is because companies and startups pivot and change all the time, not only because of market forces, but because oftentimes things will just not work, the products will just not work initially, and you have to reimagine what those products should be, and therefore you need someone that can synthesize the market and be able to have a vision on what that product is and what the value that product is offering. So some of the personal characteristics of a great CEO that we define, as I said before, vision is really important for us. It needs to be someone that thinks really high level, is able to see the market as it is and understand the pains of the market. And that takes quite a lot of vision to be able to understand things, be able to lift out of just the technology, just the engineering, and see a broader picture of what's going on. It's really important for us to have CEOs that are pretty realistic and pretty modest. It's hard to build a company, especially if you're not really transparently seeing what's going on. And I would say that oftentimes this translates into someone being pretty realistic about what they're doing wrong and how they can improve on it. We think it's really helpful to have CEOs that are highly introspective and aware of their own flaws and flaws of the company, simply because they can then identify them and fix them. Communication is a big thing for us. A CEO or someone may have great vision, may have really good technical skills, may have the ability to build a great product, but it doesn't really matter unless you have great communication, because these startups that you're building, while they start out with just a couple people where communication is not as important, they will eventually, hopefully in success, become very large companies. And the ability to manage a really large company and to do it with the same agility as a small company is a really challenging skill. Communication is the backbone of that. And so while at the very early stages of investing, through the stages we're investing, it may not be as relevant to have great communication skills. It certainly is very important later on as the company starts to scale. Low and high ego for us is the ability to be able to identify when someone has had hiccups, but also we want to back people that think that they can, in some ways naively, change the market or bring new products to market in a way that people haven't done before. And that does take a bit of arrogance or ego to be able to execute that, to have the confidence to do that. Because in reality, being an entrepreneur is an extremely irrational thing. There's tons of risk involved with it. The rewards are pretty hypothetical and low probability. And the ability to change whole markets as a small startup are extremely challenging. And so in a lot of ways, you have to have almost blind faith, their ability in your own abilities, or faith in your own abilities to be able to execute that. And then, as I mentioned before, adaptability is really important for all the reasons that the startups change pretty substantially, and a lot of that change is driven by the CEO. So moving to the next slide, these are just some key questions that we generally have as we evaluate team members. This is typically of a CEO. Generally, we ask what the track record is of an entrepreneur that we want to back, not because we think that previous startup success is essential, but more around what they view as their successes. And obviously, if they have been successful in a startup before, they have a lot of experience in bringing into it, but it doesn't necessarily have to be a startup. It could have been either a minor role in a startup, it could have been in a large company, it could have been a different endeavor that's completely unrelated. But helping to understand exactly how they've done with the challenges they've previously faced is important for us. And I would say that this is probably where we spend about 90% of our diligence. Again, this isn't necessarily startup success in previous startups. This is track record related to anything that they've done previously. The next thing is, do they have the right plan and priorities for the company? This is important largely because sometimes when you have someone coming from a domain expertise like academia or even engineering, you have a tendency to stick to what you know. And generally, when you're starting out a company, you have to be pretty objective about where to allocate resources because the resources are so tightly constrained. And so the ability to be able to look beyond your own domain expertise and to be able to execute on things that perhaps may be outside of your kind of boundary of experience is really important. And then to be able to articulate that to your team workers, to your investors, to other parties or stakeholders that are involved with the company is essential as well. The last part, this is probably more of a personal culture trait that we look for at Osage. This isn't ubiquitous across firms, but our view is that since we're backing these companies for 10 plus years, we generally want to work with someone that is easy to work with. We want someone that will be respectful in communication, that we can trust. This is not always something that is a factor for a lot of venture firms, but for us, it is really important. And then generally the things that we'll do to come to some of these questions or answer some of these questions is we'll do lots of reference calls on former employees, former board of directors, former investors, and do background checks on people as we're analyzing these entrepreneurs. And so, this kind of wraps up the team section of our evaluation framework. Matt, in the next few slides, will highlight some of the data that we look for when we're looking to invest in a company.
Yeah, so the next basically 2 slides or 3 slides or 4 are apologies are maybe a little bit life science centric in some ways, and that's my own background. So apologies if I don't hit on all the points for tech, but John can fill in the gaps, as we go. But on validating the science, we're going to ask a lot of technical questions. So our team is a bunch of science aficionados, some PhDs, people who really love reading about technology and science, who read all the literature, and can ask good questions. So that's true of a lot of venture capital firms. It's not just a bunch of MBAs pushing dollars around. They're often former scientists, especially on the life science side, or former doctors too. So they can talk shop, they can talk science, and they're going to ask a lot of good questions. So what does the product actually do? If it's a drug, do you understand the mechanism of action? How does it work? What targets does the drug bind to? Where does it bind? What effects does it have? Do you understand your pharmacokinetics? Do you understand your pharmacodynamics? These are all questions that are going to come through. And then, what's the data look like? There's an adage that some VCs use. I've heard some of the Atlas Venture folks use it. In God we trust, all others must bring data. So it's great if you say something, we'll trust you, but it's trust but verify. And the verification is seeing the data. And then again, has this been tried before? So a big question that we ask is why now? So what has changed about the science that makes you believe that now is the time to execute on this and put it into a startup? Is there some key discovery that no one knew about before? Or did the whole field have it wrong for 30 years and this new discovery, it turns out people just didn't understand the way it was working properly? Or was it a molecule that was tried in patients for cancer and it didn't really work that well? But recently we discovered how to actually select patients to find the ones where it will work for. And so we should, maybe resurrect that and take that back in with a better strategy. All these things are relevant, but the why now question is important to be able to answer. And so, in part of our diligence, we're going to do an exhaustive review of all the published literature relevant to the science that it is that you're trying to develop. We may talk about the biology and perhaps some data with experts, including consultants that VCs and we may or may not, actually be paying to get involved in the diligence process. And then, if a lot of our discussions with the company or with the CEO or with the CSO, we're also going to want to talk to that original scientific founder who made those seminal discoveries and really understand the history for those discoveries as well. So, if you have clinical data, that's a nice place to be. But it kind of opens up a whole set of questions that aren't just about the science itself. So, we're going to have lots of questions about if you have phase 1 data, and you can see some of them listed here. If you have phase 2 data, we want to know, is it truly proof of concept? Is it going to translate to your phase 3 clinical trials? Are the phase 3 studies changing in any way? Are you going to do a different patient population? Are you going to change the endpoints? We're really going to dive in and understand all of those things in a very, very detailed fashion to basically inform probability of success. So we talked about the market. So how big is it? So most products, whether it's a pharmaceutical or not, or whatever it is, don't address the entire market. They never address the entire market. They always address a segment of the market. It's important that we understand which segment of the market are most likely to be addressed. And then once we understand what that segment is, what's the penetration in that market going to look like? So that's penetration, meaning, this third bullet here, how many of those target customers will actually use the product? So, if a clinician has 50 patients with the disease, 30% of those 30 of those 50 patients are rapid progressors, so that means they should get the drug. We may ask that clinician, okay, of those 30 that are rapid progressors, and this is what the drug might do, and this is what it looked like, what fraction would you actually prescribe it to and why, and try to understand that in a pretty detailed way. So market size isn't just number of units you can sell, it's also what you can charge for those units. So market size is a dollar amount, it's a dollar figure, so it's units times price. And so, how much is it? Who's going to pay? Can you price more than other competing products on the market? Should you price less and try to, get some understanding of that? And then, third, what are the barriers to adoption? Does it really change the life of a patient? Is it clinically relevant? Is it clinically meaningful? Or is it just changing a biomarker? For a medical device, does it actually improve the patient's outcomes? Or does it just a little more convenient for the physician and maybe, they can put it in a little bit faster, or it's a little bit more comfortable, or they could sit down while they're putting in the device rather than have to stand? Whatever it is, typically if it's not changing clinical outcomes, it's usually not compelling enough for an investment for us. So with regards to the commercialization plan, most good CEOs will have some sort of plan in place, and we'll say, here's our market, and then once we launch the product, here's what we think the sales could look like over the next 10 years or 15 years, and they'll start small and then they ramp up over time. And so we'll look at all those assumptions they're making to generate those numbers and understand, are they reasonable? we want to know how they're going to reach their customers. So a call point, meaning, which clinic, if it's a drug, which clinicians will prescribe it. Is it primary care, your general practitioner, or is it a specialist? That actually has impact on maybe the sales force you might need to market the drug. And then who are the winners and losers for that product? Here's an example in this box at the bottom. So for a novel laparoscopic accessory device that improves the visibility during surgery for the surgeon. So the winner, right? The physician wins because they can see better. The patients, maybe they win. They could have improved outcomes, and maybe there's, less mistakes or less damage done if the physician can see better and see what they're doing better, maybe reduce complications. But there is a loser, right? You're probably going to charge a premium for that product, so the hospital, has added cost to be able to provide that new device for their physician. So just understanding who the winners and losers are can help you understand. And in this case, if it's the hospital making purchasing decisions, and if it's a device that's expensive enough where a surgeon can't just say, I want it, and they'll buy it, and it goes through maybe the CFO's office, you have to find a way to convince the CFO why they should pay more for something. And John, do you want to talk about operational?
Yeah, so one of the things to consider, particularly in a physical science business, is some of the operational considerations associated with that business. This is less of an issue with a software company, but sometimes it is. Oftentimes with software companies, what may look like a product-oriented company can sometimes be a service-oriented company. There's nothing wrong with a service-oriented company, but usually the margins are much lower, making it a challenge to scale. For example, Palantir, a well-known software company, is actually more of a services business where they're upcharging consultants to do data analysis for their clients, which is fine, but it does make it harder to scale those types of businesses because you're devoting personnel to a specific problem, the cost is higher, there's potential that you may not be able to service a customer if you don't have enough extra capacity in terms of humans on hand. This is typically a really big issue when you get into hardware companies, everything from semiconductor to consumer electronics companies, where you may be running a leasing or hardware business where you're renting out hardware. Then it becomes a really big challenge. It's a challenge to have 3PLs, distributors, refurbishers. And so some of these things just make it much more difficult businesses to run, which in all cases is most relevant in whether we think that this is scalable or not. Our goal is to grow revenue as fast as possible. That's largely where we're deriving value in these companies. And if there are limitations to scaling companies as quickly as possible, it becomes a little bit less attractive for us.
Thanks, John. So just to go back to move on to the IP due diligence, we get this question a lot. I'll say it's a less critical question than you might think. So, but just to highlight it, there's two stages of intellectual property due diligence. The first stage is when we're early in our due diligence. This is the verify part. So remember I said, there's this trust but verify. At this part, we're primarily trusting at this stage. So we just want to trust that, that there's no big red flags before we move forward and do all the other diligence that we just talked about, spend all our time on it. So, we just want, were there any patents filed? What's the status? When do they expire? Is there a license? We just, do some high level, and then trust you. We're not going to hire patent attorneys. We're probably not even going to read the patents, to be totally frank. We're just going to say, all right, we trust you. These things are true. Looks like you have some patent protection. Great. Then we're going to do all our other diligence. And then before the money actually gets wired to your bank account as a startup, there's going to be some IP professional due diligence where the VC firm is going to hire professional attorneys who are IP attorneys, and they're going to review the strength of the claims in those patents. They're going to look for conflicts. They're looking for freedom to operate. So are there other patents out there that you may have to infringe upon for this business to succeed? And so that's really an in-depth evaluation of IP. I'd say the vast majority of the time, it doesn't, it's not a holdup. It doesn't cause a problem. But every once in a while, there could be an issue that's uncovered that you need to work through. And sometimes it leads to the deal falling apart, and sometimes it's okay. But all this sort of expensive due diligence part, where you're actually the VC fund hires these attorneys, is all done after they have a term sheet in place and it's signed. So it's pretty late in the process. Getting to market and getting paid. So, this is appropriate for life science especially. So are there, regulatory bodies? Do you have to get through the FDA that might influence whether or not you're successful or not? So, what is that regulatory path? So for a medical device, is it a 510K or is it a PMA, which, has huge implications in terms of time and cost? You have to understand, are there any financial regulations for that industry? You want to know, what are the requirements going forward and can they be met? And so for, my life science example is, if you're developing a new drug for diabetes, the FDA is going to require you to do cardiovascular outcome studies, which are thousands upon thousands of patients and cost hundreds upon hundreds of millions of dollars. And most VCs can't pay for that. And so you will be forced into doing a pharmaceutical deal or partnership before embarking on those trials, and therefore maybe hurting your upside because there's really no other opportunity for funding for that kind of thing. And then, who's going to pay for it? Is there a reimbursement code? Is there an existing code? You need to create a new code. That's true for devices, for diagnostics. For drugs, the general rule of thumb is if you improve patient outcomes, it's most likely going to get paid for in some fashion. You may be on the formulary in a different place, maybe more restricted, maybe a patient has to fail another cheaper generic before they get your drug, but usually those things do get paid for. So this is the slide on the competition. So we're gonna do some competitive analysis as part of our due diligence. So who else? So who else has a product in this space today? So what is your bar just today from what's on the market? What do you have to be better than? But even more importantly, what's the market going to look like when you hit the market? So if that's 6 years from now, or 7 years from now, or 10 years from now, what will the market look like? That means you have to evaluate everything else in development, in the pipeline, preclinical, in clinical development, and understand, what's there, what's more interesting, what's less interesting, what is a higher probability of success, what is a lower probability of success. Really identify what are the main potential competitors that could be beating you to market or be arriving right around the same time, or could be coming right behind you that could have a better mousetrap. And so at the bottom is an example of, a sort of a shortened competitive analysis we did for when we were doing investment due diligence on a idiopathic pulmonary fibrosis company. And we looked at the time, this was many years ago, all of the different drugs that were in the space that were in clinical development, some in preclinical development, and just understanding what were the different mechanisms of action and what we thought was more interesting and what was not interesting, but really just taking stock of everything out there. And then, the conclusion from this analysis was, wow, it's a really, this is only a fraction of actually what was out there at the time, really competitive space. There's a lot going on. But then as we dug in further and talked to clinicians, we understood that, there isn't going to be one winner in this space. There's going to be a lot of combination drugs used. Different mechanisms of actions might go together. And so there's opportunities for a number of these companies and a number of these products to win in IPF. And so it wasn't sort of a winner-take-all proposition. And one way we got comfortable with that market. So I think, for the last part of the talk, John's going to talk a lot about valuation and how VCs think about setting a valuation, which I know is an important question that we often get. So John, why don't you take it away?
Yeah, so there's a misconstrued belief that VCs always want the lowest valuation, entrepreneurs want the highest. In truth, there's actually a pretty fair compromise between both parties wanting a relatively reasonable valuation. And obviously there are different definitions of what reasonable is, but the forces working against a VC wanting the lowest valuation, entrepreneur wanting the highest, is that for a VC, you don't necessarily want to dilute an entrepreneur out completely. You don't want to own 90% of the company at Series A, leaving the entrepreneur with just 10%. If that's the case, then it makes it really challenging in terms of incentivizing the entrepreneur to really put forth their best effort. You want them to participate in the success of the company, to be driven and motivated by the potential outside return. And so, there is a strong desire for most VCs to increase ownership for entrepreneurs or maintain pretty substantial ownership. typically companies will exit with founding CEOs owning around 25% of the company. This is after kind of hundreds of millions of dollars invested, which is a pretty reasonable target to shoot for. Entrepreneurs, the reason why they wouldn't want the highest valuation is that whatever the valuation that they raise in, they're going to have to raise the next round at a higher valuation. And they want to be able to make sure that they can reach the milestones in order to make that next valuation. And so if they're not able to do so, they'll face what's called a recap. And a recap is far more dilutive than raising at a slightly higher valuation in a previous round. They'll essentially have to raise a next round at a much lower price, and they'll get diluted way more substantially than they would have originally. And therefore, there's a pretty fair compromise between the two parties. On the next slide, this is generally something that we put together for every deal. This is to understand what the possible exit scenarios are for a company. And so this is just a list of different companies that have exited over time in a specific space. We'll usually identify kind of the year this acquisition happened, the type of company, the company that acquired the company, the areas to make sure that it's pretty consistent with the area of the company that we're exploring, and then usually the economics of the deal. In life science, you'll often see upfront payments versus milestone payments. You have to discount the milestone payments because it's based on whether an asset can get through certain clinical trials, which is highly risky and oftentimes low probability, though the milestones can be set to be more attractive as well. And so you get to a general deal total. This is relevant when calculating for us what the valuation should be to understand what type of multiple we can expect on the deal. Most VCs are looking to underwrite kind of a 10x deal. And so if they think the exits aren't going to be there, then it doesn't really matter what the valuation is. If the valuation is low enough, obviously you can get to kind of that type of multiple. But it's just kind of the basic back to envelope math that we generally try to do when looking at a deal. On the next slide, we generally try to identify or understand what the history of financing of the company has been. And it's not only just the capital that's been raised, but specifically, as I mentioned before, we want to see the entrepreneurs' employees incentivized. And so the cap table is important for us in that context. Oftentimes, actually, sometimes what we'll see are really bad angel deals where angels will own 50% of the company to the first round of funding, and entrepreneurs will own 40%. This is a no-go for us. And in those situations, you'll either try to recapitalize the company prior to financing, or you'll just pass on it. And in most cases, you just pass on it because it takes a lot of work to recapitalize the company. And so making sure that the capital structure ahead of an investment is sound is pretty important, and actually leads to a lot of passes as well. Another thing we look at are the previous investors strong investors or not. There are differences in quality of investors. There are people that are not as savvy, not as experienced in venture investing, and this plays a role in redemptions. This plays a role in how the company raises capital in the future. This plays a role in how much capital the company has from existing investors if things were to go slightly awry as well. And so, it's important for us to be investing with a group of investors that we're pretty comfortable with, that we know are good actors, because there are a lot of bad actors out there, and you don't really want to do business with those. And then the last thing that we really want to understand is what's the purpose of the financing. Sometimes companies just raise to de-risk things, to have a little more cash in case things don't go perfectly in the business. This is reasonable. Other times, it's to do something very specific, but oftentimes what we want people to identify is a very specific inflection point that they're going after. This is relevant because if they hit that inflection point, then they can raise capital at a higher valuation later on. So the next slide kind of highlights what I mentioned before on doing the math before and after. And so in the first the first line is the initial pre-money, which is the valuation that you set. The post-money is the pre-money plus the money that's going in. And so if it's a $10 to $30 million pre-money and you invest $10 million, it's a $20 to $40 million post-money. And that's valuation with the money that you invested at the end of your investment. And then the other side of that is kind of what you expect to exit the company at. And so in this case, if you close the deal at a $20 million post-money and then there's no other capital raise, no other dilution, you sold the company at 200, that'll be a 10x multiple. If you raise money at a $40 million post-money and sold it at 200 million, that'll be a 5x multiple. You know, that range is still pretty attractive. I would say the 5x is a little less attractive, obviously. The 10x is what you want to go for. And this is why early stage valuation is pretty important. On the lower line, you see a company that's very highly valued at a $50 million pre. That would be a $60 million post. And, you know, that would be less than a 4x. And so that simply wouldn't work for us. Therefore, we would pass on that deal, and we would think it would be too expensive. So the next slide is just kind of the last stage in what we do for our own investments. We'll generally write an investment mini for the investment committee. Investment committee are the general partners in a firm that have the ability to say yes or no to a deal. Generally, you want to go through unanimous approval of the deal. These are the GPs in a fund. And so that investment memo will identify kind of what the deal is that we're looking at, what the company does, what our interactions and what the technology is, why we want to invest in that company, what types of red flags we've identified, any objections to the deal that the team has brought up, we'll identify those. We'll generally present this investment memo to the investment committee, and then that will be the trigger to get it approved. And then usually it's the analysts, associates, principals, some partners that are creating these investment memos to bring to the investment committee. And then on the last slide, you know, it is variable from the firm, but usually as the investment memo is presented to the committee will not just be the committee, but it'll usually involve the entire firm. It'll provide an opportunity for everyone to either dissent or approve of the deal. And then if everyone's okay with it, usually you're trying to go for the unanimous approval of the deal. You will submit and sign a term sheet, which it's generally a competitive process when you submit a term sheet. So even after this entire process, you could lose the deal to another firm. And if they do choose to go ahead with your term sheet, then you will start drafting the legal documents, and then you'll negotiate the actual terms of the documents. That usually takes about 3 weeks, and then you will get final signatures and then wire the money after that. And that is the entire process of walking through a deal from start to finish in terms of all the work that we do, and then all the things that we look at generally when trying to underwrite a deal. Great, and so you know, the last slide is just generally a thank you for attending. As a reminder, we're a venture firm that invests in companies that have spun out of universities. We partner with over 100 institutions across North America, Israel, Singapore. We're deep technology, deep science investors, sector and stage agnostic. And so if you do have any questions, please do email us. If you have questions related to life science, Matt would be your point of contact. If they're physical science oriented, I would be your point of contact. And so thank you for attending. Really appreciate the time.